Welcome to this explainer. Investment banking ledgers are usually guarded like, well, state secrets. But today, we're cracking open Evercore's financials to see what is really driving the stock of this absolute heavyweight. Whether you're actively managing a portfolio or just kind of fascinated by the mechanics of market-beating companies, Evercore is a case study you absolutely need to understand. We're going to strip away the noise and look directly at the data, the fundamentals, and the valuation models that dictate exactly where the stock has been, and more importantly, where it might be heading. Let's just start right here, 2,082%. Seriously, it's almost hard to conceptualize, right? But an investor who got in 20 years ago has seen their capital multiply over 20 times. That is the sheer power of relentless compounded wealth creation. Now, obviously, as informed investors, we know the golden rule. Past performance doesn't guarantee future results. So we really need to figure out how they did it, and if that engine is still roaring. To make sense of all this, here is our roadmap. First, we'll look at a history of massive returns. Second, financial health and profitability. Third, dividends and cash flow. And finally, the valuation dilemma.
All right, Section 1, a history of massive returns. Let's unpack that track record. Talk about an aggressive whiplash. In 2022, Evercore took a 17.6% hit alongside the broader market struggles. But then, look at this reversal, a massive 60.5% surge in 2023, followed by an even hotter 64.3% jump in 2024. This isn't just a slow, steady climb. It tells us that when the macroeconomic conditions are right, Evercore has the capacity to rapidly accelerate and generate absolutely outsized returns for its shareholders in a very compressed time frame. And you've got to see this trailing 12-month total return compound annual growth rate. Sitting at just over 105%, it perfectly highlights the sheer momentum the stock is riding right now. I mean, in a single year, the total return has essentially doubled an investor's money. It's wild. But as focus learners, we have to ask the hard question. Is this just a sugar rush, or is there genuine substance keeping this momentum alive?
That brings us to Section 2, financial health and profitability. Let's look under the hood.
I absolutely love pointing this out. An incredibly low 0.29 debt-to-equity ratio tells a story of extreme financial safety. In the high-stakes world of finance and investment banking, leverage is often the silent killer. But at 0.29, Evercore is practically debt-free. For every dollar of equity, they hold a mere 29 cents of debt. This gives management incredible flexibility. They aren't bogged down by interest payments, meaning they can weather economic storms and pivot on a dime when new opportunities pop up. Looking deeper, Evercore's capital efficiency is exceptionally strong compared to its historical averages. Their current ratio sits at a very healthy 2.16, meaning their short-term assets easily cover short-term liabilities twice over. But the real stars of the show here are the returns. A return on equity of over 29% means they're just ruthlessly efficient at turning shareholder cash into profit. And the return on invested capital? A staggering 35%, which is actually up over 11% compared to its 3-year average. Honestly, management is allocating capital like absolute masterminds right now. Furthermore, they boast a near-perfect 99% gross margin. Now, in the advisory space, high gross margins are pretty common because, well, you aren't manufacturing physical widgets. But 99% is still something to admire. More importantly, we see a highly respectable 14.2% net margin. What you should take away from this is that a very solid chunk of every dollar coming through the door makes its way straight to the bottom line as pure profit. Plus, that net margin is up over 7% from its trailing 12-month average. They aren't just growing revenue, they're actually getting more profitable as they grow. Moving right along to Section 3, dividends and cash flow. Let's follow the money trail. 19 consecutive yearly dividend increases. That is an incredible streak. They've consistently rewarded shareholders through thick and thin, recessions, booms, you name it. But here is the real kicker. They're doing this with a tiny 21.9% payout ratio. They're only using about a fifth of their earnings to cover that dividend. So the crucial point here is that they have massive safety and plenty of room for future growth. Add in a 5-year compound annual growth rate of 6.6% on that dividend, and you've got a highly reliable income stream. And the true engine funding those safe dividends, it's this massive billion-dollar free cash flow. Over the trailing 12 months, Evercore generated $1.18 billion in free cash flow. This is the absolute lifeblood of any business. Even more impressively, that cash flow has been growing at a 32% clip over the last 3 years. Think about it. When a company is practically debt-free and generating over $1 billion in free cash flow, they hold all the cards. They can hike dividends, buy back stock, or aggressively reinvest in the business. Finally, we arrive at Section 4, the valuation dilemma. Let's assess the price tag. At roughly $348, the current price is up over 80% from its 52-week low of about $193. Whenever stock nearly doubles from its recent bottom, the immediate question every smart investor asks is, wait, has the train already left the station? Is the stock now dangerously overextended, or are the fundamental business metrics actually keeping pace with this explosive price action? Well, if we look at traditional metrics, the market is definitely demanding a premium. The PE ratio is almost 25, and the price-to-book ratio is 6.59. Historically speaking, these ratios are sitting slightly elevated compared to their 3-year and 5-year averages. For example, the current price-to-sales ratio of 3.54 is over 11% higher than its 3-year average. So on the surface at least, the standard metrics are flashing yellow, suggesting the market has already priced in a lot of premium for Evercore's recent success. But hold on a second, look at the PEG ratio. Sitting at an incredibly low 0.45, it tells a completely different story. Even with an elevated PE, when you factor in Evercore's explosive earnings growth, remember that massive 44% trailing 12-month EPS growth rate? This incredibly low PEG indicates the stock might actually still be significantly undervalued relative to its massive trajectory. Which brings us to the ultimate valuation dilemma. Look at how 2 different discounted cash flow methods yield wildly different fair value targets for the exact same company. If we build our model based on earnings per share, the fair value comes out to around $201. But if we build our model based on free cash flow, the fair value absolutely skyrockets to almost $700. That is a massive, head-scratching disconnect. Let's look at what that actually means for your margin of safety. Relying strictly on the earnings model signals extreme overvaluation, suggesting the stock is trading at a negative 73% margin of safety. Basically, it's saying you are overpaying dramatically. But relying on the massive free cash flow generation we discussed earlier suggests a huge bargain, a positive 50% margin of safety, meaning the stock still has tons of room to run. This just proves that valuation is often as much an art as it is a science. You really have to decide which metric, accounting earnings or raw cash flow, is the truer measure of Evercore's future. Which leaves us to ponder the final tension of this ledger. The fundamentals are undeniably stellar. They're practically debt-free, margins are fantastic, and they're generating over $1 billion in cash while consistently raising dividends year after year. But depending on your math and whether you trust the PE ratio or the free cash flow models, are you paying a premium at the top of a rally, or are you getting a total steal on a growth engine that's just now shifting into its highest gear? So what do you think the true driver of value is here? Until next time, keep analyzing, keep learning, and I'll see you in the next explainer.